With that, Bob, did you have anything that you would like to talk about?
I just want to welcome everybody to this session, and we're really pleased that Michael took the time to be able to give us this update. And as Harry indicated, so much has changed. We didn't want to wait until January of next year. And Michael has always been so gracious to provide our area with this kind of information, and we really appreciate him doing this extra session here at almost the halfway point. So thanks, Michael.
No problem.
Thanks, Bob. And with that, Michael, you are on.
All right, just confirm to me that you get my screen. So do you see the presentation first page?
We do.
Okay, perfect. Then we're good to go. All right, well, good morning to all of you. It's afternoon here. I'm conducting this from my basement in Luxembourg at the moment. It's not the first time I've done it down here. We've been doing a lot of webinars for clients and industry associations and doing a lot of university courses in recent months. So this has become somewhat of a familiar speaking point for me. I have the office upstairs, but with two kids and a lot of their friends around, it's a lot easier to come down here and to be heard by all of you. So what I'm going to do today is talk about what's happened in the last few months. Now, the presentation structure, if you've seen me speak before, you'll recognize it because the structure is almost identical, but we're going to look at just how the COVID pandemic has impacted the global economy, the US economy. We'll try and talk a little bit also about the impact on the Ohio economy and some of the things that we're looking at going forward. There we go, I have to click on that. So again, we're going to look at some of the key issues and trends around the world, obviously with the COVID pandemic being the #1 issue right now and how that's impacting some other issues. We're going to look at, again, we'll go region by region. We'll talk about what's happening around the world. Now, I warn you, the numbers are not pretty. It's hard as an economist to imagine some of the numbers that we've been filling in our forecasts over the last few months. As was mentioned, I spoke in New Philadelphia right at the end of January. I had other speaking engagements throughout February. The last one I did was the last day of February in San Diego. And by that time already, all of the Chinese attendees were no longer there. And then in March, I was ready to speak in Madrid, which was became one of the hotspots. And that event was canceled the day before it was going to take place. And then since then, all of the actual events that I was to have spoken at in Brazil and Thailand, all over, they've been canceled. So we've got this new normal now, which is me at home presenting to the world. So let's get into this. The key issues and trends. Now, every year when I do the Groundhog Day presentation, we focus on a few key issues, a few key trends. This year, you'll remember there were 3. If you were in New Philadelphia, I talked about the fact that we've had major trade and investment disruptions. We talked about changing demographics, and we really focused a lot on productivity. Now, all of these things are being impacted by this new disruption, which has hit this year. And that, of course, is the COVID-19 pandemic. So let's talk about where we are in the world right now with the COVID-19 pandemic. Now, where I am in Luxembourg, we were one of the first places to be hit really hard. We were skiing in Austria in the second part of February, right before the outbreak occurred there and in northern Italy. And within a matter of a couple of weeks, Europe went from having almost no cases to being shut down completely. I have a number of friends who came down with COVID-19. Fortunately, all of them are okay. But anyway, that was where we saw the first big jump. We knew about this since January. But it took about 2 months until this went from being a very localized problem to something that has shut down the global economy. And as you can see on the chart there, in terms of the number of new cases being diagnosed every day, it's continuing to go up. Now, part of that is a product of simply more testing being done, but nevertheless, we're finding more and more outbreaks in different parts of the world. As far as the US is concerned, now the US is quite unique in its COVID case numbers, if you will. We saw a major increase in the latter part of March, centered around New York City. In fact, for the first few weeks of the outbreak in the US, half the cases in the US were in the greater New York City area. What we've seen then was a gradual decline in the number of new cases until the month of June. And we've seen a sharp increase in new cases, particularly in places that were not hit early on by the outbreak. We're seeing major increases in the numbers in places like Texas, in the Southeast, in California, and that's resulted in a new upturn in cases. Now, fortunately, the fatality numbers continue to come down. Now, there's a lot of discussion about how the US has handled this crisis. Certainly in terms of preventing cases, it does not look good, but there has also been some positive news. Certainly the healthcare infrastructure has done a very good job at preventing fatalities. The US has one of the lowest fatality rates in the world. Nevertheless, as the number of cases go up, we expect a lot more disruption to the US economy in the months ahead. I am of the opinion, and I'm not a virologist, I'm an economist, and I do study numbers. I've been doing it my entire life. It looks to me like this is going to come in waves. It's going to come back until we have a vaccine, and a vaccine that's distributed worldwide. And that means it's going to take some time until this pandemic is brought under control. And by some time, I mean not until at the earliest 2021. You see around the world where we've been looking, I mentioned, it started in China. Now, China's numbers, we really don't trust their numbers as far as their case and fatality numbers. Where we saw the first big outbreaks, again, was in Southern Europe. We saw a big outbreak in Iran. We saw a big outbreak in Mexico City. Where we've been seeing it lately now, it's been shifting, and it's been shifting particularly to emerging markets. We're seeing a lot of cases in Latin America. In fact, no region is being hit harder at the moment than Latin America. We're seeing it spread across Africa and the Middle East. Now, the numbers look small in those areas, but believe me, there's very little testing taking place. The word on the ground is that the number of cases is substantially high. And the concerning part is that in places who had the outbreak under control, places like South Korea, Australia, Germany, we've seen in the last few days some pretty significant outbreaks in those countries. So even the countries that have dealt with preventing cases at let's say a higher level than others are finding that they're still subject to new outbreaks popping up every now and then, and that's forcing lockdown measures to be put back in place in those countries, and that's bad news for the economy. Any hope for a V-shaped recovery, I think, is overly optimistic. We're looking at something much more like a U, perhaps a W, hopefully not an L, but definitely not a V-shaped recovery. We are going to experience some long-term impacts, which we'll talk about going forward. Again, a couple more slides on what's going on with the pandemic. You see that Brazil is a country that is being hit incredibly hard at the moment, and that's with relatively little testing being done in Brazil. So the true number of cases and fatalities in Brazil is probably significantly higher than what we've seen. We've seen major increases in India, as I mentioned. So a lot of these high growth or economies that were expected to grow at a decent rate being hit particularly hard by the pandemic. So how is this impacting the economy? Now this slide, I took this slide from January, but there were only a couple little points on there. We've added some more. Now, if you remember when we talked about this in January, we talked about the impact primarily on supply chains. Already by late January, we were seeing a lot of US-based manufacturers having their supply chains interrupted because Wuhan and Hubei are major manufacturing centers, particularly for the automotive industry and also for the electronics industry. And we were seeing those manufacturers have their supply chains disrupted. So that was really the first economic impact of COVID-19. The second one then was the fact that suddenly the Chinese market, which is the fastest growing market for most US-based exporters, it shut down. So we went from having a supply chain problem to the loss of what was expected to be the biggest growth market. The Chinese economy was forecast to account for about 1/3 of all additional economic output this year. Obviously, that's not going to be the case. We started to see disruptions to shipping and travel. This was right about the time, late January, early February, where we were seeing flights being canceled. We were seeing ships being stuck at sea. We were seeing that afterwards when I mentioned in Europe, when the number of cases went through the roof, that's when we saw share prices collapse, at least temporarily. In March, we saw a huge decline in share prices. We saw a huge decline in commodity prices. I'm sure in Eastern Ohio, as you're all aware, the The price of oil was minus $37 a barrel in the US for a short period. Commodity prices fell pretty sharply across the board. Now, we've seen commodity producers cut output in many parts of the world to try and boost commodity prices, and that's had an impact in recent weeks. But there's going to be a lot of weakness on the demand side going forward. So we don't forecast any significant increase in commodity prices. The next big step then was into April, May, we saw major declines in consumer and business spending. The retail spending numbers we saw in April around the world were incredibly bad. Now, we had a better than expected number in the US in May, almost double of what we expected the rebound to be. But we are forecasting a lot of uncertainty both in business and consumer spending over the next few months, particularly if new waves of this pandemic occur. And then, of course, as was mentioned, the job losses. The US unemployment rate went up to 14.7%. It's since receded to 13.3%. In other parts of the world, there have been job losses or a lot of government programs put in place to keep people in a job, not officially counted as being unemployed and earning some money, but really not doing any work. We mentioned the impact on the stock market. Now, the share price collapsed in March, as we mentioned. It bounced back, particularly in the United States in the weeks thereafter. It was really, there were a number of reasons why it did. They weren't very good reasons because the fundamentals of the economy were quite poor. But as we've seen in June, we've again seen some weakness in stock markets. And a lot of that has to do with the growing realization that this is not going to be a V-shaped recovery, that there's going to be pain down the road. It's going to be difficult for a lot of industries, a lot of sectors to really bounce back over the next 12 to 18 months. Industrial production, this was hit from the earliest days of the pandemic. We're looking at about a US decline of almost 10% in industrial production, a similar number worldwide. Asia will do a little better. Europe will do a little worse. But this is the largest decline in industrial production since the 1940s. So industrial sectors, we've seen some of the numbers, for example, in automotive, where automotive factories were just shut down for a number of months. And this is going to have a long-term effect. There's a lot of stock not being sold. There's a lot of backlog in terms of supply, but we expect demand to take some time to recover. So this is going to have an impact 12, 24, 36 months going forward. Consumer spending, now this is from a month earlier, but if we looked at some of the numbers into April and May, they also look quite bad. Even in China, we saw major declines in retail spending. And what's concerning is in a lot of key economies, we have not seen the level of recovery that was hoped for. Now, I mentioned the US, retail sales bounced back stronger than expected, but in most major retail countries, they did not, at least not yet. And again, there's going to be lingering effects. We're seeing a lot of volatility at the moment, but there's going to be a lot of uncertainty, particularly the longer this uncertainty lasts, the more savings we're going to see and the less consumer spending growth we're likely to see over the next year. So if businesses and consumers aren't spending, who is? Well, that's clear, it's the governments. We're seeing some massive fiscal stimulus programs being put in place in the US, some very aggressive stimulus measures, not quite as aggressive as in Japan, but nevertheless quite aggressive. In other parts of the world, we haven't quite seen that yet. They're trying to, here in Europe, try to get something similar in terms of scope as what the US has, but there's a lot of disagreement among countries. A number of emerging markets just don't have the ability to enact such large stimuli. So we're not looking at, in many of these poorer countries, we're not looking at major stimulus programs. What we are looking at, though, in the developed world, in Japan, in the US, and in Europe, is probably even more stimulus measures being put in place in the months ahead as the economy struggles to get back on its feet. Now, this, of course, is going to leave a lot of debts to be paid. And if economic growth doesn't recover over the longer term to where it was, and we'll talk about that later, this is going to be highly problematic in terms of paying off this debt, because we are accruing some massive debts in the developed world at the moment. So I'm going to talk more about economic forecast later, but this chart shows the 10 largest economies, what our current, this is up to date as of today, I believe, or yesterday, Our forecast for the 10 largest economies, of the 10 largest, only one economy is forecast to realize any growth this year, and that's China at 0.8%. Everybody else will be shrinking by at least 4.5%. Even India, which was a country growing by 8% per year until a couple of years ago, going to shrink by almost 5%. We've got the US down 6%. We've got Canada down almost 8%. We've got Europe as a whole down almost 10% this year. It is going to be a very, very difficult year. We're looking at our forecast right now for the global economy is I believe it's minus 5.4%, which would be the worst result for the global economy since the 1930s, the early 1930s. And I can say that since we've been updating these forecasts, which we're doing basically on a weekly basis, almost all of the revisions have been downwards. There have been no revisions where we've said, oh, we're being too pessimistic right now. We need to be more optimistic. And that's the same for basically every major bank, for the IMF, for the World Bank, that the revisions have been consistently downward in terms of forecasting in recent weeks. Now, how does this compare to other great disruptions? Now, all of us are below the age of 100, so we've never lived through anything terribly seriously. In fact, since World War II, there have only been two major economic crises. One were the oil shocks of the 1970s, where we had great inflation in the US, for example. I remember those as a kid. I can remember driving in my father's giant, a Pontiac Bonneville, and the newsman on the radio talking about inflation rates in double digits, which are unimaginable now. But anyway, the impact on the global economy was not that great. The global economy never shrank for a year during the oil shocks. During the financial crisis, it did. In fact, the only time since World War II the global economy did not record growth was in 2009, when it shrank by just 0.1%. So I'm assuming none of us remember any of the crises from before World War II. If we did, then we would know what major crises can do to an economy. In the time of World War I and the Spanish flu, we had times where the global economy shrank by almost 10%, at least in 1914. In the Great Depression from 1930 to 1932, the global economy shrank by almost 10% per year. So we have not, when we look at the moment, a forecast of minus 5.4%, this is something we have not experienced as a global economy in pretty much any of our lifetimes. And it's going to have ramifications that we don't even quite see yet, because some industries that we know are going to be transformed completely. Many companies that we've known throughout our lifetimes are likely to disappear. And if this pandemic continues, if we start looking at continued disruptions into 2021 and hopefully not into 2022, but if we do, the level of decline will be even greater. So that's something we need to pay attention to. Now I'll go through this section. Now this section has taken a lot from what we talked about in January, and I want to just mention how the COVID pandemic is impacting these key issues. Now we're going to talk, I won't go through this list here because we have a slide for each one. One of the big things has been global trade. And one of the reasons we talked about that earlier this year was because global trade has been depressed now since 2012. We've basically recorded less than 2% global trade growth per year since 2012. This predates the US-China trade war. This predates the Trump administration. Global trade, US trade, was weak for a number of years now. Now, what are we forecasting this year? We were forecasting a decline in global trade before the pandemic of about 2 to 3%. Well, we're forecasting a decline of 25% this year in global trade, and a huge number when we really look back at the history of global trade. Now, global trade growth, if you remember, in the 80s, 90s, was, even in the early 2000s, was consistently above 10% per year. We're looking this year at a 25% decline in global trade. And what that means is that we are unlikely to see global trade levels return to where they were before the pandemic until the middle of this decade. As long as commodity prices remain low, as long as we have trends like localization and automation, and if history is anything to go by, when we have a crisis like this, countries tend to become protective. They tend to look to build at home and create jobs. So the outlook for global trade over the next few years is quite dire indeed. You remember in January, we talked about the phase 1 trade deal between the US and China. That's become a discussion again in the last few days. Now, the the Trump administration has said, we expect China to adhere to the terms of the deal, even with the pandemic, which makes it pretty unrealistic that it's going to be adhered to. So this is going to be an issue, probably an issue in the election coming up. I think the numbers for President Trump are quite dire at the moment in terms of his approval rating. This is one issue I suspect he is going to push hard on in the coming months. And it could well add to the tension. If you remember back, you probably don't remember, but if you read back about the Great Depression, it was not just the stock market crash, but it was the protectionism and the tariffs that were put in place in the years after the stock market crash which turned a downturn into a depression. We need to be careful that we avoid that trap this time, but there are a number of pitfalls that we have to watch out for. Another one is between the US and Europe. There's been a lot of discussion about issues such as digital taxes, which European countries are threatening to impose. We've talked a lot of discussion within the automotive and aerospace industries. It's not just in the United States where we're seeing an increase in protectionism. You're also seeing that increasingly in Europe. So the potential for you have US-China trade war on one side, you have the potential for a US-European trade war over the near term on the other. And why are we seeing these trade troubles? We mentioned the manufacturing jobs going away. We don't expect that just because there's protectionism and just because more factories will be built at home, that many more jobs will be created. These are going to be very automated factories, of course. We talked about a lack of wage growth. Now, that was something that was changing before the pandemic. In 2018, 2019, in the US and other countries, we were seeing improved levels of wage growth, but this pandemic certainly will do nothing for that over the next few years. Protectionist policies, as I mentioned, both on the left wing and the right wing are increasing. And again, the pandemic will certainly add to those pressures. I mentioned the technological changes. We've been talking about this in recent years. I think this crisis will really accelerate that. We've seen historically when major economies are faced with such a crisis, an acceleration of technological change, an acceleration in process change, and that's going to probably happen this time as well. I mean, this is a good example, us being on the Zoom call right now, of new processes and new technologies to communicate and to educate one another. And then, of course, demographic changes we talked about quite a bit. Now, who's most at risk? The US, of course, is facing a relatively low level of risk from protectionism because only 11.5% of our economic output is derived from exports. You compare that to countries like Germany and South Korea, Mexico and Canada, and you can see the US has a much stronger domestic market, at least as a share of its economy, than those countries. And those countries are the most at risk, not just from the pandemic, but from the after effects of this pandemic over the next 3 to 5 years. And we've substantially lowered our growth forecast for a number of those countries, not just this year, of course, but into the 2020s as we go. And as protectionism remains in place and as global trade remains weak, those countries will be particularly at risk from those type of disruptions. It's not just trade. Foreign investment has been declining in recent years. And again, we're forecasting a decline. I think it's above 30% now in foreign investment this year. Now you have some cases that a lot of our clients are major corporations who sit on a lot of money, and they view this as an opportunity because they say, well, we have a lot of targets, if you will, or companies we're interested in purchasing, but they're not interested in selling. A lot of them become very interested in selling when faced with something such as the COVID pandemic. So we're going to see a increase from those companies in terms of purchasing, but everywhere else, foreign investment will be down over the near term because of the pandemic, because of the uncertainty over the pandemic, and because of protectionism being put in place. We're seeing this all over. A number of countries have put in new legislation in recent weeks to prevent foreign acquisitions of key assets, if you will. India has done that with all potential investments from China. The French are encouraging the Europeans to do that for strategic industries. We're seeing this all over the world. Again, this is a common response to a crisis. And this crisis being such a major crisis, we expect this to occur in the coming months. Again, so why is foreign investment declining? Lack of business and investor confidence, which of course has nosedived as a result of the pandemic. Changes in monetary policy. This is interesting. Of course, we've seen interest rate cuts across the board in the wake of the pandemic. Interest rates are at zero, near zero, and in some cases below zero in most major economies now. There's no likelihood of interest rates going up anytime over the next couple of years. Every central bank has basically communicated to the markets that we're going to keep interest rates low at least into 2023, if not longer. So we're looking at that type of a future. And if you look at currencies, on the other hand, the dollar has been relatively strong, and as long as the crisis is taking place, the dollar will retain a lot of its strength because it remains the #1 safe haven currency. I was forecasting in January a strong dollar regardless. This just reinforces that forecast that the dollar is not going to weaken significantly in the coming years. Commodity prices, of course, are going to stay low, and that's also deterring investment in a number of commodity ventures. We've heard a lot in the oil and gas industry about exploration activities being put on hold for a number of years in a number of parts of the world, not only because of the immediate crisis, but because of the impact this crisis could have on long-term oil and gas demand. As you know, there are less cars and less buses and less trucks on the road, less planes in the air. And a lot of governments are interested in utilizing this crisis to reduce their carbon footprint and by reducing such traffic. And that may be a long-term effect of this crisis. And again, as I mentioned, localization and automation, something which is going to continue. Now, if you remember in January, one of the themes we talked about was the fact that there just weren't enough workers in the world. Well, that changed about 10 weeks later. We went from, as was mentioned, a 3.6% unemployment rate in the US to a 13.3%. Ohio is just a little bit higher at the moment. As I mentioned, most other parts of the world, we haven't seen the sharp increase in employment. That doesn't mean more people are working. They certainly aren't. Most economies have been hit even harder than the US. At least most major economies have been hit even harder than the US by this crisis. But there are programs in place to keep people in their jobs, even if they're not working. They're receiving a share of their pay, for example, subsidized by the government. Now, that can't go on forever. And the longer this pandemic keeps causing disruptions, the more difficult it's going to be for those governments to keep those programs in place. And again, finally, we talked a lot about productivity in January. This is not going to help productivity growth at all. We've been seeing a decline in productivity for decades now. There are the hopes, of course, that new technologies and new processes will emerge, and perhaps this crisis will be the impetus for such an emergence. But without that, we don't expect a major increase in productivity. It's certainly going to fall this year, and we'll look how that goes going forward. But if you're not growing demographically, if you're not growing through trade and investment, your only avenue for growth, as you remember, is productivity. And if we're not doing that, we're not growing. And that's a huge problem for the global economy going forward. You know the issues we talked about, the technologies and processes, a lot of industries struggling. This may be an opportunity for a number of industries to shed some of their weaker companies, weaker sectors, if you will. Those companies who are not productive or not increasing their productivity or not profitable, they may fall by the wayside in this crisis. And that may be an impetus for longer term productivity growth. Remains to be seen. But that is one possibility. Rising inequality, of course, we've really seen a problem in terms of lower segments, at least in income segments of society, contributing to productivity growth that's really been lacking in recent decades. How this crisis will impact that remains to be seen. And then a lack of business investment. This crisis is not going to help that at all. We've been seeing that in recent decades. We're seeing an even sharper fall in business investment at the moment. So bad news for productivity, as those charts just show. You saw those charts in January. So it's a dangerous combination we're facing right now. We were already facing declines in trade and investment, which is in many ways a self-inflicted wound. As I mentioned, demographic growth is not coming back. We're dealing with falling working age populations, falling birth rates. That leaves productivity growth to drive growth, but unfortunately, we've had very little productivity growth around the world in recent years. And you take all of that and you throw the biggest pandemic since the Spanish flu into the mix, and you have what is the worst economic crisis in the world in 100 years. It's a bad mix. I remember people saying I was too pessimistic a few years ago on these presentations. I sound even more pessimistic now, unfortunately. So let's look at the global economy. Let's look at some numbers, both from a global standpoint and from a regional standpoint. What are the key questions? The number one question is, how long will these disruptions last? That's the big question. We have virologists working with economists now to try and determine what will the long-term impact be of this pandemic on the economy. Nobody knows for sure. I am pessimistic from the perspective that we keep seeing it popping up over and over again. Perhaps it's not as dangerous as it once was because fatality rates seem to be falling. Viruses mutate throughout the life of pandemic, and perhaps it is now weakening, and perhaps we're building up slowly, very slowly, an immunity to it, but it spreads very easily. And we see all around the world new outbreaks popping up. And that is scary for me because not only is it the summertime in the Northern Hemisphere, and we're seeing this happen, but when the fall comes and it becomes flu season again, we may see another major outbreak, which may force lockdown measures to be put back in place, which would be devastating for the global economy. Think about it. We had about 10 or 11 weeks of serious lockdown measures in most major economies, and we're looking at a decline in global economic growth of over 5% this year. So what would a second lockdown be? Remember the Spanish flu in 1918, and it had its worst part was the second wave. There was a first wave in the early part of 1918, which was bad, but it was the second wave in the latter part of that year, which triggered the most deaths, the most fatalities from that. So again, this is not the Spanish flu. It behaves differently. It may be totally different how it evolves, but there is a risk there. So how long will it be until growth returns? We'll talk about that in a little bit. One thing we'll look at is, will this cause irrevocable harm to weaker economies? Now, if you remember the financial crisis in 2008, 2009, think about the problems it caused for economies that were already struggling, economies like Italy, economies like Argentina, and many others. That was a mild recession compared to what we're facing now. So do more countries and more industries who were struggling in recent years, can they bounce back from this, or does this really set them back for the foreseeable future? That's something we need to look at. Developed economies, I'll talk about that in a minute. Asia, of course, was becoming the center of global growth for some time. It is anticipated that Asia will not suffer the level of declines in economic output that other regions will suffer from this year. So will that shift the balance of economic power even more towards Asia? We were talking about emerging markets that weren't in Asia, how badly they've been performing, and we'll see that they're really going to struggle as a result of this pandemic. And then we'll talk a little bit more about global trade. So the global economy, as you can see here in this chart, we are now forecasting as 5.4% decline. Now, as you remember, as I had been talking about a lot, between 2012 and 2018, we had the most steady global growth we've ever had in recorded economic history. The global growth didn't shift from anywhere between 3.4 to 3.8%. Now, we already saw a slowdown in 2019 when the global economy fell below 3% for the first time since 2009. And we were forecasting a little bit of a slowdown as well in 2020, not 5.4% decline, however. Now, we are forecasting for the moment a recovery of about 4.7% in 2021, but that, of course, is completely dependent upon how this pandemic evolves in the coming months. But nevertheless, it's not a full recovery. Now, we saw on a global basis a full recovery, more or less, from the financial crisis, particularly from emerging markets. If you remember, in the wake of the financial crisis, it took developed economies, the rich world, some time to bounce back. Emerging markets came back very quickly, and they were driving growth for those years in 2010, 2011, 2012, before the US and others started to get going. There we go. Okay. So let's talk about developed economies. Now, if you know that chart at the bottom right, if you've been to any of my presentations, it shows how global economies, developed economies, excuse me, have been slowing over time. From the 50s through to 1980, they were growing at more than 4% per year. In the last 2 decades of the 20th century, excuse me, they grew 3% per year. And in the first 2 decades of the 21st century, they grew a little bit less than 2% per year. Well, thanks to this pandemic, we're looking at the rest of this decade, we're forecasting only about 1% growth overall per year in developed economies. The rich world is continuing to slow. There's a number of reasons for this. Simple demographics. Some of the oldest countries in the world in terms of population characteristics are among the world's wealthiest countries. Birth rates are extremely low in much of the developed world. And there's been a shift of investment into many emerging markets, particularly in Asia. So we're looking at the developed world continuing its slowdown, with this pandemic contributing to that. Well, let's look at some of the key developed economies. We'll start right where you guys are in the US and Canada. We're forecasting a decline in the US this year of 5.9%. That's slightly optimistic perhaps. If I'm thinking of the major forecasters, they're generally between -4 and -8% for the US economy. So we're right now at -5.9. The retail sales in May were favorable, the bounce back. That gives us hope that consumers will continue to spend at a higher rate than in other parts of the world. Nevertheless, there are going to be significant disruptions. We're seeing some new lockdown measures being put in place where they haven't really been in place before. So it's going to be a difficult year. It's going to be even more difficult for Canada, of course, because they rely so much on the US export market, and they have their own crisis to worry about in terms of the pandemic. So we're looking at deep recessions across North America this year. We're looking at relatively strong bounce backs next year. Next year, at the moment, we've got about 5% growth in the US and Canada. That's a little bit optimistic in terms of the outlook compared to others, but we do think that the US has some room for growth. And again, because it's less dependent upon exports than most other major economies, that benefits it when you're dealing with such a crisis at the moment. Let's look at Ohio a little bit, how Ohio's been doing. Now, I've taken this data from the BEA, so they're the official data for the US states. We saw growth at about 2% per year in recent years in Ohio, just a little bit below the national average. And if you put that on a per capita basis, it was right about the national average. So the Ohio economy had been doing pretty well. We've seen, though, already we're starting to see a pretty sharp slowdown. We're looking at a huge slowdown in the second quarter, almost 40% on an annualized basis. That's pretty close to where we have the US forecast for the second quarter, followed by a relatively stronger third and fourth quarter. But nevertheless, that won't be enough to keep the Ohio economy from shrinking by more than 5% this year. I think we're at 5.3%, which is a little bit better than the US average. There's some reasons for that. The Ohio economy is less dependent upon travel and tourism, for example, which is going to be the hardest hit sector probably of them all in 2020. And then we're looking at a relatively strong bounce back, a little bit below 5% next year. Again, the same factors that are impacting the US economy are impacting Ohio. If this pandemic causes future lockdowns, that will have an impact on the outlook for Ohio. Ohio's done a pretty good job, certainly in terms of keeping the numbers of cases down. When you look at the neighbors, when you look what's happened in Michigan and Pennsylvania, and obviously what happened around New York City, and now what's happening in the South, Ohio's done a very good job. All over the world, Governor DeWine is on the news. Certainly I've seen him here on enough of the news programs out of the UK and other parts of Europe that he is being held up as an example of a government leader who has been effective at dealing with this crisis, certainly in comparison to a lot of other government leaders. And so Ohio has received a lot of positive press worldwide because of its ability to keep the numbers down. And it was a relatively quick action by the government. Ohio has a relatively strong healthcare infrastructure. Of course, coming from Cleveland like I do, we're always proud of the Cleveland Clinic and all of the other hospitals in that part of Ohio. And so that has played a role in keeping the situation relatively under control in Ohio. Again, Ohio is not that dependent upon international trade as many other US states, and most of Ohio's trade is with Canada and Mexico. So that is a favorable thing, because if we look at how is this going to evolve, we're looking at bubbles eventually where countries start to open individual borders to one another, open to more trade, more travel. And we can foresee eventually a North American bubble being created at one point prior to, let's say, trade accelerating with other parts of the world, and that could be favorable for Ohio, at least over the near term. That'll keep trade from falling quite as much as the national average. Same for foreign investment. Ohio has quite a diverse investment portfolio, if you will. There's not one single industry that completely dominates foreign investment into Ohio. That again, we look at as a positive, and the investment comes from a number of different parts of the world. So again, having that broad footprint in terms of investment, but having a relatively narrow footprint as long as it's with the neighbors in terms of exports, both could work favorably for Ohio in terms of avoiding some of the issues with the pandemic over the next few months, even over the next couple of years. So let's go to other parts of the world then. We looked at North America. What are the other rich countries in the world doing? Well, one region that's being hit very hard by this is Europe. Europe, as you know, is very trade dependent. It was anyway forecast to fall into a recession. If you remember the presentation in January, we were forecasting a recession this year for Europe. Now we're forecasting growth of, a decline in economic output of almost 10% in Europe this year. Some economies, Spain and Italy, are approaching 13% in terms of their contraction this year. The French economy forecast to shrink by about 12%, the British almost 10%, Germans about 8%. These are huge declines, and these are countries that have relatively weak domestic markets. They remain much more dependent upon exports. They have, some of them, certainly in France and Italy and Spain's case, have very large tourism sectors. In some cases, tourism accounts for almost 20% of total GDP in some of these countries. So those are sectors that are going to be hit particularly hard. So it's going to be a very, very difficult year for Europe. Europe's exposed as well to any other major disruptions that could be caused by the pandemic over the next months or into the next year. So it's a very difficult time for the European economy. And this is Europe's now 4th recession in the last 12 years. So this has been a very uncertain time for the European economy as a whole now. Economic output by the end of this year will be smaller than it was in 2008. So basically you're looking at a lost 12 years of economic output for Europe. The other developed region is the developed Asia Pacific region. That's Japan and then a handful of East Asia and Oceania countries. Japan's economy is of course being hit pretty hard by this. It's forecast to shrink by a little more than 6% this year. It was already shrinking as well. Japan's economy shrank in the 4th quarter of last year because a sales tax was implemented in October of last year. So Japan entered this pandemic also from a position of weakness. Now we've seen some other economies perform poorly, but not quite as poorly as the other developed economies we talked about. One of note is Australia. Australia had not been, well, it's still not officially in a recession just quite yet, but it hasn't been in a recession for the longest period since we've been keeping economic records for any large economy. Well, it's about to fall into one. So even the strong economies in recent years are being hit pretty hard. So if developed economies are going to have a difficult time and shrink by about 7% as a whole this year, what's going to happen in emerging economies? Now, this is where the growth was coming from. In the wake of the financial crisis, when we look at 2010, 2011, these were the drivers of the global economy. They were accounting for almost all the economic growth in the world, and all emerging markets were growing there for a few years. Really from 2010 into 2014, all emerging markets were growing. Money was flowing into them. Commodity prices were high. Exports were booming. They were doing well. And then in 2014, commodity prices fell dramatically. We saw shifts in monetary policy, particularly in the United States. And we saw a big division. We saw Asian emerging markets continuing to grow relatively healthily, but slowing nevertheless. In emerging markets outside of Asia, not growing at all. So what are we looking at this year? We're looking at a decline of more than 3% in economic output in emerging markets, and we'll talk about where that decline is coming from. They are in a little bit better position to recover because they have growing domestic markets, and some of them will continue to receive investment as businesses and investors look at long-term growth possibilities as opposed to short-term growth possibilities. So we expect economies in the emerging world to pick up speed a little bit faster than in the developed world, just like what happened after the financial crisis. But there'll be some big differences. Now, China Now, China's had some volatility. You remember we talked about how China's growth slowed to 6.1%, official growth that is. You can always take it with a grain of salt, but 6.1% growth last year. We're forecasting it to grow by less than 1% this year. And the Chinese government, for the first time since 1990, is not offering a growth forecast for this year. That tells you just how bad the situation has gotten. Now, we know their official number was in the first quarter of this year that the economy shrank by almost 7% in China. They were the first one into a lockdown. They've been the first one out of a lockdown. So there is a lot riding on the second quarter number. If it does look positive, that bodes well for the Chinese economy in the second half of the year. But if the second quarter number also looks very poorly, that suggests that there is a lot of lingering effects in terms of consumer spending, business spending. And so that will be watched very closely. China, as I mentioned, accounts for 1/3 of all global economic growth today. So any slowdown in China is going to have a big impact around the world. Now, the other giant emerging market in Asia is India. Now, India, if you remember in previous years, was growing at about 8% per year. It was growing quite rapidly. Now, that started to slow in recent years. In fact, last year, the Indian economy grew by just a little more than 4%, which is a terrible result for a country whose population is already growing by 2% per year. Well, this year, it looks like the Indian economy is going to shrink by almost 5%. The unemployment rate, and it's very hard to calculate the unemployment rate in India, there's a lot of informal employment there, but is now estimated to be 23.5%. They announced their lockdown 4 hours before it went into effect. They announced it in the evening, and 140 million workers couldn't get home because, of course, a lot of Indians come from the villages to the cities. They shut down public transport within 4 hours, so 140 million Indians could not make it back to their homes once the lockdown was announced. And that hasn't stopped the coronavirus from spreading rapidly across that country. The numbers are growing quite a bit, even with extremely low levels of testing. Southeast Asia, another key driver of growth in Asia, also forecast to shrink now this year by a little bit less than 3%. Countries like Thailand that are hugely dependent upon tourism are going to be hit harder than those like Vietnam or Indonesia, which have growing domestic markets and are receiving investment that was supposed to go to China. We have been talking about in recent years that a lot of companies want to lessen their dependence upon China. It doesn't mean they're bringing all of their manufacturing and all their operations back home. They're also looking at other emerging markets. And those are the beneficiaries of that have primarily been the less expensive countries in Southeast Asia, such as the Philippines, Indonesia, and in particular, Vietnam. So what's happening outside of Asia? Now, Central and East Europe was already slowing last year. We're forecasting a decline of about almost 6% this year in economic output in East Asia. Russia is being hit very hard by this crisis because not only have they had also a very bad pandemic, but they've suffered tremendously from the collapse in the price of oil and gas. So it's been a very difficult time for Russia. For most other countries in the regions, they're being hit hard by the fact that their key export markets in Europe have weakened. So there's very little opportunity for growth in this region over the near term. The Middle East and North Africa also forecast to shrink by about 6%. Now keep in mind, whereas the population in Central and East Europe is declining, here the population is growing quickly. So a decline in output of 6% has a huge impact on poverty levels. It leaves a lot of people out of work. It leaves a lot of people destitute. And when you really look back over the last 7 or 8 years, there's been relatively little growth now generated in this region. It's almost becoming a lost decade for this entire region. We've seen so much unrest, so much conflict in this region in recent years that this type of economic collapse can only add to the political pressures there. Sub-Saharan Africa, now we are still forecasting growth for Sub-Saharan Africa. This is an advantage of not being dependent too much upon other economies. There's still so much subsistence agriculture in the region. So much of the trade is internal. The only countries really going to suffer are going to be the big oil exporters. Countries like Nigeria and Angola, or big commodity exporters like South Africa. They're forecast to fall into sharp recessions this year. They've been struggling really since 2014 to generate any growth. The other countries in the region where a lot of the trade is internal, they're going to slow down, of course, some of them substantially, but they should still record some degree of growth in 2020. And then finally, the region that's been performing the worst among the emerging regions is Latin America. The Latin American economy is forecast to shrink by 9% this year. It's not been growing at all, really, over the last 6 or 7 years. This will just add to the misery of the region. 2020 was expected to be a region where some economies pulled out of their struggles of late, particularly Brazil and to a lesser degree Mexico. Now we're looking at declines of about almost 10% in GDP growth in 2020, with a relatively slow recovery going forward because the domestic markets in this region are still quite weak. The financial health of a lot of the governments in this region are quite weak. There's very little investment going into the region. It's been a very tough time for Latin America, and that's not going to change over the next couple of years. So what should you take away from what we've this tour of the world, the slightly pessimistic tour of the world, certainly more pessimistic than it was a few months ago? Look, 2020 is going to be the most difficult year, at least since the Second World War, and probably economically, at least since the early 1930s. Developed economies, they've been slowing for decades. This is just going to add to the downwards pressure on them, including in the United States, but even more so in places like Europe and Japan. Emerging markets, again, that division between those that are competitive or those that are in the right location and those that aren't is just going to continue to grow. We're going to see a higher share of the investment around the world going into places like Southeast Asia, in emerging markets in that region. Other regions, particularly Latin America, but also the Middle East and parts of Eastern Europe, also are going to struggle. And this could be a turning point for some of them. This could be the point where they really can't generate growth for a prolonged period of time. And that's a big risk because as companies do look to export and they see that China has been the growth market and India was supposed to be a big growth market, but it's disappointing. All those other big countries out there, places like Brazil, Russia, Turkey, South Africa, I can go on, just not providing many opportunities for growth over the next few years. And again, finally, the coronavirus crisis, we don't know how it's going to play out. We do know that there is a big potential for future disruptions for not just months, but for years to come. The fact that the hopes for a quick recovery really have faded. Now, not everything is pessimistic. I have a slide, which my last slide has to be something optimistic. So there are some reasons for hope, and there are reasons to keep your heads up and to be ready to compete for markets, for investment, for products, new products, for technological developments. And what are some of them? The shock of this pandemic could really force businesses and industries to develop new methods and new processes to boost productivity. As I mentioned, productivity growth has been declining for decades. But if we look back in history, when have some of the greatest productivity increases in developments been made? They've been in times of crises. Think back to World War II and all the scientific developments that were created during that terrible event, or all of the processes developments that were created during that event, all the technological breakthroughs that came through. We can use a crisis in a positive way, and this is one such crisis. Perhaps that will be one of the outcomes, that we do boost productivity, because that's really the only way we're going to grow in the future. It's forcing businesses and industries to become more efficient. Look, we're all here. We didn't have to leave our houses or our garages or our backyards or wherever we are. We're all discussing here, dozens of us talking about the global economy. We didn't pollute doing this. We didn't have to drive or fly anywhere. Perhaps we do become more efficient, and perhaps we do have a better impact or a lesser impact on the environment going forward because of the lessons we're learning during this crisis. Certainly, we're going to be better prepared for future shocks. We weren't very prepared for this shock, as we're learning, very to our detriment. But this will prepare us for other future shocks going forward. And then finally, since the Industrial Revolution, the global economy has always bounced back. We've always found a way to return to growth, no matter what, whether it was the Spanish flu or 2 world wars or major crises in the 19th century. We've always found a way to bounce back. That's a reason for hope, that yes, this is a dark time for the global economy and for specific businesses and specific industries and for individuals who may have lost their jobs or may be uncertain about the future of their jobs. We've always bounced back. The global economy has always bounced back. And that is a reason to hope that yes, 2020 will be difficult, but we will come back and we will grow again going forward. So that's that's it for me. If anyone has any questions long-term, if they forget something today and they would like to ask me a question, there's my email. You can also visit our website there at isa-world.com if you want to learn more about what our firm does and what we do to help companies in this crisis. We're helping a lot of them right now. Believe me, this is to be an economist personally at this time. It's one of the most challenging, but interesting as well. We're living through history as this transpires, and so it's a fascinating time, but of course a challenging one. So that's it for me. If anyone has any questions, we do have a little time, I think, to answer them. I'll turn off my screen share, I believe.
Okay. Michael, we do have just a couple of questions. This one is from Michael Johnson. Last January 31, you related that U.S. manufacturing sector already had slid into a recession. How big a drag on the U.S. economy recovery will be a recessionary manufacturing sector?
Well, it certainly would be a drag, of course. The thing that will lift us out quickly would be consumer spending. But if as you saw, we were still growing as manufacturing was already into a recession. And we knew that 2020 was going to be difficult because export demand was weakening, because business investment levels were disappointing. So if business investment doesn't pick up, let's say in the latter part of this year or early next year, that could have a major detrimental effect on the economy. Not as much as a lack of consumer spending would have, but certainly would have an impact. Absolutely.
Thank you. And then this question from Josh Harris. If there's accelerating investment in automation, will this eventually have a positive impact on productivity growth?
That's the hope. That's the big hope. We did see, if you really study productivity numbers, we did see in the late 90s in countries that had large IT, large information sectors, an increase in productivity growth, but it was temporary, it was short-lived, and eventually it fell, the downward trend continued. The big hope is that processes, automation, artificial intelligence, other type of 3D printing, what have you, that eventually that does lead to increases in productivity. And perhaps this crisis will spur some of that because companies have been forced to rethink the way they do business, the way they produce products, the way they provide services. So perhaps we'll see that. I'm still skeptical just because we've been disappointed by productivity basically for my entire adult life. Yeah, it is, we have to. I mean, if we want to continue growing, and that's really been my big research focus in recent months, besides dealing with this pandemic, has been on productivity issues and how we can recover in terms of lost productivity growth. Yeah.
Thank you. Thank you so much, Michael. That was a tremendous 1 hour, very compact list of information. And you know, under the circumstances, there does seem to be just at least a few points of positive news as well.
Sure.
And that's a good thing, isn't it? Because you know, many of us still working from home, or in and out of the office, and as I see you are as well. Exactly. Hopefully the storms haven't come in too strong.
I see that it's getting dark outside, but it haven't hit yet. So the Wi-Fi didn't disconnect, or there was nothing like that.
Which was certainly our biggest fear, actually.
It hasn't happened yet, so I think we have it works pretty well here.
Yes. The next year we'll be having our 14th global forecast on January 29th, I believe. Yep, January 29th, 2021. And hopefully that will be done in person. But if not, we will join together just like we are right now, again on a Zoom call. If you haven't had enough of economic information about the pandemic, we will be zeroing in more on Northeast Ohio with our partner, Team NEO. That's our Jobs Ohio affiliate. And that is going to be on September 25th. It'll also be a Zoom meeting. At least at this point, that's what we believe it's going to be, because we think that that's probably the best way to handle it at least until we have a vaccine in place, right? That's going to be the golden ticket, I think. There's also a question, just a couple of last questions. The PowerPoint will be available, and in fact, that'll be sent out to all of the participants today, and as well as a recording of this presentation will be, a link to that recording will be sent out to all the participants as well. And that'll be available, that link will be available on the Tusk EDC website. So again, thank you, Michael. We really appreciate your time and your efforts in bringing us up to date as to where we are, where we were, and now where we are now. And hopefully some of the things that you've said won't come true. And then next January 29th, we'll be listening to, well, you know, things actually recovered better than what we thought they might.
I wouldn't mind being wrong for once. Yeah.
Yes. All right. Any last questions? All right.
All right.
Bob, anything from you?
Thank you all very much.
Thanks, Bob. And John Kelly, anything from you?
I think we covered everything.
All right. Jason Ricker.
Thank you very much. Everybody have a great day.
All right.
Same to
And
you.
thank you. Michael, have a great day.
Thank you. You too. Thank you.
Thank you.